Welcome to the deep dive. Let's get straight to it. How many times have you set a stop loss, watched it get nicked by just a tiny price move, and then poof, the stock just rockets off without you?
Yeah, it's incredibly frustrating. We hear that a lot.
Exactly. So that feeling, that premature stop out, that's what we're tackling today.
And our goal in this deep dive is really to show you how the average true range, ATR, it seems like a simple indicator, but it can be a really effective tool.
To help sidestep those unnecessary losses.
Precisely. And help you make, smarter trading decisions overall.
Okay. And we're digging into a YouTube video from Trading Chanakya called ATR Stop Loss Secret for some insights here. So ATR, what's the basic idea? What's it actually measuring?
Well, at its heart, average true range is all about measuring market volatility. It won't tell you which way the price is headed, but it tells you how much it tends to move.
How much it swings around?
Exactly. Calculates this by averaging the true range of a stock over a set period. Usually the default is 14 periods, like 14 trading days or candles on your chart.
Okay, true range. That sounds important. How's that different from just, the daily high minus the daily low?
Good question. That's a really key distinction. The simple range is just that, high minus low for the day. But true range, it goes a step further. It actually counts for price gaps between yesterday's close and today's open.
Ah, like if a stock jumps up or down overnight.
Exactly. So
Yep.
say a stock opens at 50, closes 55, the low is 45, high was 60. The
Yeah.
simple range is 15 rupees, right? 60 minus 45.
Right.
But the true range calculation looks at that high-low and compares it to the previous close to capture the full volatility, especially if there was a gap. The video example uses those numbers, 50 open, 55 close, 45 low, 60 high, and yeah, the true range there is 15 rupees.
Okay, got it. So it captures the whole picture, including those gaps. And ATR is just the average of those true ranges over, say, 14 days.
Yep, that's pretty much it. It smooths out the day-to-day fluctuations to give you an average sense of the recent volatility.
So practically speaking, how do we find this ATR on our, trading platforms? Is it easy to spot?
Oh yeah, most brokers, most platforms have it built in.
Yeah.
You just look in your list of indicators, add ATR, and it usually pops up as a line graph below your main price chart.
Okay.
And that line will move up and down as the stock's volatility changes. The video uses ITC as an example. When they recorded it was trading around 425 rupees.
And what was the ATR value then?
It was showing 7.95.
Okay, 7.95 for ITC at 425. What does that number, practically tell a trader?
It suggests that, on average, over the last 14 days, ITC tended to move about 8 rupees between its high and low point each day, roughly 8 rupees.
Right.
And the video even shows a specific day where the high was 429, the low was 422. That's a 7 rupee range. So, yeah, it lines up pretty well with that ATR value.
So knowing that average daily range, can we sort of estimate how much a stock might move tomorrow?
Well, it's not a crystal ball, obviously, but yeah, it gives you a reasonable expectation based on what it's been doing recently. You could say take the opening price and add and subtract that APR value, that 8 rupees for ITC, to get a potential high and low zone for the day.
Okay, that's handy for understanding one stock. Now, the video also compares volatility between stocks using ATR. How does that work?
Right. This is where it gets really useful. They bring in another stock, CIE Automotive India, trading around 80 rupees at the time.
Okay, much lower price than ITC's 425.
Yeah, but here's the interesting part. ITC's ATR was about 8, right? 7.95. CIE Automotive's ATR was 13.14.
Whoa, significantly higher ATR on a much lower price stock.
Exactly. That's the power of ATR.
Right.
It shows you directly that even though CIE Automotive's price is lower, it's actually much more volatile on average than ITC. It has a potential daily swing of around 13 rupees compared to ITC's 8.
Huh. So ATR lets you compare that swinginess regardless of the share price itself. That's really useful.
Definitely. It gives you an objective measure of volatility.
Okay, so now we know how volatile a stock might be. How does this tie back into setting better stop losses and avoiding those frustrating early exits?
Right, this is the core of the stop-loss secret idea. The video points out a super common mistake. Traders setting their stop losses way too tight. Often they set it within the stock's normal daily range, the range indicated by the ATR.
Like setting an 8 rupee stop on ITC when its ATR is also 8 rupees?
Exactly. What do you think happens then?
You're basically asking to get stopped out by just normal, everyday noise, even if the trend is fine.
Precisely. The stock just wiggles around like it normally does, hits your stop, and then maybe continues in the direction you wanted. So the video suggests using multiples of the ATR to give your trade more breathing room.
Okay, multiples. Tell me about that, like the 2x rule.
Yeah, the 2x ATR rule is the first suggestion.
Mm.
Take the ATR value, let's stick with ITC's 8 rupees, multiply it by 2, which gives you 16 rupees.
Okay.
So if you bought ITC, you'd place your stop loss 16 rupees below your entry price. The idea is this significantly reduces the chance of getting stopped out by just random daily fluctuations. It turns a potentially very high-risk tight stop into more of a moderate risk stop.
That makes intuitive sense. You're respecting the stock's typical movement. What about going even wider? Is there a 3x rule too?
Yep, the video mentions the 3x ATR rule for an even more conservative approach.
Yeah.
For ITC, with that 8 rupee ATR, 3 times 8 is 24 rupees.
So 24 rupees stop loss below entry.
Right. The video calls this very less risky, meaning it's even less likely that normal daily volatility will knock you out of the trade prematurely.
Okay, this is a really different way to think about it compared to just picking like a 1% level or a random support point. You're basing it on the stock's actual behavior.
Exactly. It's dynamic. And the video actually gives a bit of homework, which I think is great.
Oh yeah, what's the challenge?
Go back, look at some of your past trades where you got stopped out. Calculate what the 2x ATR was at the time you entered the trade. See if setting your stop loss at that 2x ATR level would have kept you in the trade.
Ah, see if it would have saved you from that premature exit. That's a powerful exercise.
Definitely. It lets you see the practical difference this approach might have made.
Okay, really valuable. Now, the video also talks about applying ATR within specific strategies like trading breakouts. How does it fit there?
Good question. Let's take a swing breakout example, maybe on ITC again, like in the video. Let's say right when the price breaks above a key resistance level, the ATR at that moment is, say, 6 rupees.
Okay, ATR is 6 at the breakout point.
Applying the 2x ATR rule, 2 times 6 is 12 rupees. So if you entered long at maybe 465 when it broke out, you'd place your stop loss 12 rupees below at 453.
And the idea is that 12 rupee buffer should be enough to handle any initial pullback or volatility right after the breakout.
Exactly. It gives the trade room to establish itself without getting stopped out by noise, assuming the breakout holds, of course.
Makes sense. What about the opposite scenario, a breakdown below support?
Same principle applies, but the video makes an important point. When a stock breaks down, volatility might actually increase. So the ATR value at the time of a breakdown might be higher than during a stable period or even a breakout.
Okay.
In their breakdown example, the ATR was around 9 rupees, higher than the 6 we just used for the breakout.
So higher ATR means?
It suggests you might need an even wider stop loss, maybe 2 times 9, so 18 rupees, to account for that increased volatility. It also might hint that potential profit targets could be larger if the breakdown really gains momentum.
So ATR adapts. It's not just one fixed number for a stock forever. It reflects current conditions.
That's the beauty of it. It's dynamic.
Now, lots of people use support and resistance levels for stops. Does ATR replace that or work with it?
The video definitely suggests using them together. ATR isn't meant to completely replace looking at chart structure like support and resistance. It complements it.
How so? Can you give an example?
Sure. Imagine you've identified a nice support level. You calculate your 2x ATR stop loss distance. If that 2x ATR calculation puts your stop comfortably below that support level, great. You've got confirmation from both structure and volatility.
Okay.
But what if the 2x ATR stop falls slightly above a clear support level? Well, you might then decide to nudge your stop down just below that support, knowing that the ATR suggests normal volatility shouldn't reach that far down anyway. Or vice versa. If ATR suggests a much wider stop than the nearest support, you place it based on ATR, respecting the volatility.
So you're using ATR to kind of sanity check or refine your stop placement around those key price levels.
Exactly. It adds another layer of data-driven confirmation to your decision.
The video also mentioned Bollinger Bands, I think, linking ATR to other strategies.
Yeah, it briefly suggests that if you use strategies like Bollinger Bands, which are also volatility-based, you could experiment with incorporating ATR for setting your stops within that strategy's framework too. The core idea is always the same. Use ATR to get a realistic sense of the noise level, the normal fluctuation, and set your stop outside of that range.
And the payoff, hopefully, is cutting down on those unnecessary stop-outs.
Yeah.
Even saving a few trades from that fate can make a real difference to your bottom line over time, right?
Absolutely. It's not about winning every trade, but about not losing unnecessarily.
Yeah.
Avoiding those premature exits where you're actually right on the direction can significantly impact profitability and, frankly, your trading psychology too.
Yeah, definitely less frustrating. Okay, so to kind of bring it all together then, ATR, average true range. It's a straightforward indicator available on most platforms. Its main job is to measure a stock's recent average volatility, its swinginess.
Correct. Based on the true range, including gaps.
And the key application we discussed, drawing from the Trading Chanakya video, is using multiples of that ATR, like 2x or maybe 3x, to set a stop loss that gives your trade enough room to breathe.
Yeah, to avoid getting shaken out by just the normal daily noise.
Basing it on the stock's actual measured volatility rather than just guessing or using a fixed percentage.
Exactly. It's about tailoring your risk to the specific character of the stock you're trading right now.
Seems like a really practical takeaway. That 2x ATR rule is something anyone listening could probably go and test out pretty easily.
Definitely worth experimenting with and doing that homework, reviewing past trades.
So, here's a final thought for you to chew on. If you really start to understand and adapt to each stock's inherent volatility, measured by something like ATR, how might that fundamentally change how you approach setting stops, managing risk, and maybe even how you view your trades overall?
Something to think about. It's about aligning your strategy with market reality.
Indeed. Thanks for taking this deep dive with us.